Hello and welcome. You're watching The Investing Edge. I'm Sumaira Abdi, and joining me today, as always, is Feroze Azeez, Deputy CEO of Anand Rathi Private Wealth Management, and Mr. KR Girish, who's been an investor now for 25 years. Gentlemen, thanks very much for joining in. In fact, it's been quite an eventful week where, I didn't think we could see growth go so much in the negative, but yeah, close to minus 24% gets you talking, right? So, Feroze, I want to first talk about just that because, for a long time now, I've heard you say that every time the macro parameters don't look so good, the market shouldn't be worried. It doesn't necessarily mean that it's an equally bad time for the market. Does this correlation hold when the country's growth plunges to what, minus 24?
Yes, Sumaira, we've been discussing this for quite some time. And of course, the macroeconomic variables seem disconnected at several points in time from the capital markets, especially the equity markets. So this is an attribute which equity has shown. But this is a very exaggerated period of a contraction in the economy, 24% for the last quarter. Thankfully, it's just the quarter, is something which is not something which we've seen in decades. Or ever since India has started measuring quarterly GDPs. So point one is, of course, we, with this kind of base, will have growth from here on. That's the optimistic way of looking at it. But economy has several variables, several sectors. Agriculture is one. Capital markets may not actually be the right measure of how the economy will do or how economy will impact the capital market or vice versa. Because equity markets is about 200 companies, 250 top companies, which take 90-95% of the equity markets. And a very well diversified kind of a space, right? Because you have IT companies, you have telecom, you have engineering, you have construction, and several different sectors represent the Nifty, for example. So to answer your pointed question, does it keep me worried? Yes. To a certain extent. But I am an optimist, so I would like to believe that things can only get better from here. Point two is the Asian economies numbers have not been so bad. Today we are driven largely from a liquidity standpoint from FII inflows. If you see the last couple of months, FIIs have continuously been buying, but the domestic investor, institutional investor, the DIIs have been selling. So we are driven by a lot of global liquidity. So I think that's not too much of a worry. Third, we are driven by retail investing. The number of accounts have gone up exponentially during these periods of lockdown. That's a sign of a little worry that there could be heightened volatility in the future. Because every time you see retail participation coming in the fag end of the bull run. So that's one little negative sign. But if you give it 6 months, I think whatever has to pan out of this pandemic and the corresponding collateral damage to the economy will pan out in the next 4, 5, 6 months. So if a person is patient and allocates his fresh money marginally in a staggered fashion, I don't think there's too much to be worried about.
Okay, Mr. Girish, you've been investing for more than 25 years. And, what wouldn't you have seen, right? Before this, the global financial crisis, the many scams that we saw in the Indian market. Were you ever worried about your investments? What has been your experience of, dealing with such kind of crisis moments?
See, Samira, I had an advantage of because of my professional qualifications and because I am myself a finance guy, I don't get quickly perturbed by certain dips and certain kind of volatilities. So take, for instance, the financial crisis of 2008, the Lehman Brothers. I think there was a great panic in the market. I think people were exiting out and all that. So I said, things will improve. And again, a fair amount of scams, specifically for India. I think the point which I had always noticed is, if you are an investor, you have to be a long-term investor. Unless you're a long-term investor, you would not see any money growing on your account, on your wealth. So I think you cannot get into a short-term scenario of 3 to 5 years and all that. It has to be at least 5 and above. So to just take you, I didn't start with any big corpus. Started with a very small corpus and started building it and building it, building it. And that's how you build a corpus. So it's over a period of time. Yes, I think there has been times where you really get worried. But then, as Feroze rightly said, I'm also an optimist. I wouldn't say I'm an eternal optimist. I'm an optimist. And that is what has made me keep on to my investment for long. And again, I've been working with Anand Rathi for quite some time now. And I think as we go along, I will just answer. I'm sure you're going to ask me a lot of questions on that. I'll share my thoughts on that.
Yeah, it's just heartening because we have a lot of experts who come and, talk about how it's important to stay invested for the long run. But there's nothing really like hearing it from an investor, right? Because other investors who are watching, people who are watching resonate their voices with other investors. And, this is a very important point you've raised. And as the saying goes, that somebody's standing under a tree today because somebody planted a seed, right? But Feroze, let me come back to you. How does risk reward work in a market like this?
I think the risk reward is today also favorable. Like Mr. Girish mentioned, the time frame. See, risk reward for the next 2 months may not be favorable. Back in June, the risk reward was favorable even for a 2, 3, 4 month period. That's why at Anand Rathi we made short-term products as an exception. So to answer your pointed question, Sumira, risk reward is not favorable, maybe for the short term, could be as short term as 3 to 6 months. It may not be favorable. The risks are more than the reward. But from a 3-year standpoint, I strongly believe that the risk reward is 70-80% favoring reward than on risk. So it also depends on what the time frame we are speaking of, and what happens is, like we human, what colors our mind or what takes precedence is the short term, not the long term, because it takes you to visualize 3 years, 5 years from now, and that doesn't come to all of us naturally. So the risk reward in the short term might not be as favorable, but it's very favorable from a 3 to 5 year perspective, especially if your advisor can create excess return and manage your risks to half of what Nifty takes and generate you 4-5% extra on the overall balance sheet than Nifty, then you have a winner as a strategy.
Okay. Mr. Girish, how have you looked at this? Because, when you started off, you mentioned that, you started with a very small corpus that was more than 25 years ago. Did you know much about risk at that time? How did you sort of align your portfolio to your risk profile? What has been your experience with risky investments, for one? How would you describe this entire thing?
See, the advantage, again, I go back to my academic learning, because I am a chartered accountant by academic, right? So we do understand risk a little bit better than others. Having said that, I think the way I look at it is, you got to, as Feroze rightly said, you got to evaluate risk with the growth story. And I always believe, and that's where my optimism comes, I always believe India is a great growth story, and it has still not started that. I would believe that if you believe in India growth story, I think the risk are worth the thing to take. Because reason really is, there are not very many economies in the world which would really give you that kind of growth in the years to come. So the way I looked at risk is, risk cannot be looked at in isolation, but risk has to be looked at with a growth factor. If there is a growth and you see there is a clear potential for growth, yes, it's worth considering a certain amount of risk. So in fact, if you really look at it in my portfolio, I do have a fairly weighted kind of investment on equities. When I say equities, primarily mutual funds and Nifty structures. But predominantly, I believe it's because of the reason that I believe India is a great growth story still to happen.
That's true. A rising tide lifts all boats, right? So why not? Feroze, 2020 is really turning out to be the year from hell, right? So if somebody, let's say an HNI, had to start, or they had thought that I'm to start my investment journey now, would you say that they're at a disadvantage, or would you say that they're at an advantage given the opportunities that have arisen because of the volatility? How do they start their investment journey in 2020?
There are several advantages. There are some disadvantages. Depends on how you construct the portfolio. To my mind, lower markets, today I would say it's lower because the last 3-year return on Nifty is a couple of percent, 2-3%. So that's not too much of return behind us. So it's an advantage. Vis-a-vis a client who began or an investor who began in 2017, you are at an advantage if you're a beginner. As an HNI, you've divested your business or you've sold some property and you want to get into a reasonably balanced asset allocation, it's a good time. One, because the return for the last 10 years on Nifty has been 6-7%, and last 3 years on Nifty has just been 2%. That's why I probably completely would, not just probably, completely would endorse what Mr. Girish said, that it's yet to happen. So from a level standpoint. Second, if you're choosing the right products in the current context, where the volatilities are something which the product can benefit out of, rather than just see that as a demerit, like structure products, which he also alluded to, Nifty linked debentures, they benefit from the volatility. So I would say there are advantages for you to take only if you cherry pick the vehicles you use to participate. If you're going to be buying just an index fund, assuming nobody else can add extra return for myself, may not be. But there is going to be huge growth potential of different businesses. Diverse businesses behave very differently in times like these. If it is great times, all businesses will do well. So stock selection done by a fund manager will be far more meritorious than in a full-blown bull run. So to answer your pointed question and summarize what I just said, it's an advantage if you so chose to take it. Second, there will be disadvantages if you're going to be getting innovative in creating portfolios by using fancy products. These are times where you have to keep away from them and not fall prey to fancy ideas and fall prey to heightened innovations than desired.
Yeah, and I always agree with everybody who says keep it simple. A quick break, we'll be right back, and on the other side we're going to talk about what works best in different market scenarios. So what's a good instrument for a rising market, a falling market. So basically you should have the advantage all the time. A quick break, we'll be back with more on that. Welcome back. You're watching The Investing Edge. With me, as always, is Feroze Azeez, Deputy CEO of Anand Rathi Private Wealth Management. And we also have Mr. KR Girish, who's been an investor now for over 25 years. Mr. Girish, I have one more question for you, which is, which has been the best or the worst product that you might have used? I mean, all of us have been prone to mis-selling at some point or the other, right? So what has been your experience? And you mentioned that, you've been a chartered accountant. So did you get fooled at some point, and what did you learn from it?
Okay, I wouldn't say that I ever got fooled. That I wouldn't at all agree to that. But I think the best product, I think, of Anand Rathi, which has really worked well for me personally, has been, I'm a great fan of their structured products. And I have taken, yes, there is a risk element in that because you are banking on the volatility of the market. And to that extent, there is a risk. But nevertheless, I think that product has done pretty well for me. Coming back, I think on the standard products, there is very little to differentiate. I think Feroze would agree on that, especially on the investment in equity mutual funds. There are certain funds which has not performed so well as per the analysis. That I would not say it's a bad advice, but I think it didn't really take off. So overall, I would say the experience has been good.
Feroze, I have a question for you because, you've always advocated that investors should invest with a strategy in mind, right? But there is some sort of space available for tactical allocation. So therefore, if somebody sees that, the market suddenly goes up, what would be a good instrument to sort of play that tide? I mean, how does an investor ensure that they always have the advantage? I'm also going to ask you what to pick in a falling market.
Yes, the tactical allocations are meritorious. About 10% of your money in the tails of the market can be a tactical allocation, point one. Point two, depends on that particular situation. What was right previously may not be right the next time you see something as an opportunity. This time around, what was the biggest opportunity? Was the heightened volatility, right? And I speak about it very often because that was such a big opportunity, which quite a few people have benefited also. So point two I'm making is volatility this time was 87. 1 month volatility was 87, which was significantly more than even 2008, because pandemic was such a fresh new variable which people have not seen in their lifetimes. So panic and the fear was at a level which was very different for that momentary period. So 10% of your money can capitalize on this volatility being transformed into rupees, and that's where we launched the 1-year product. So structure product was used this time around. But sometimes you also have mutual funds which can help you do a tactical allocation. Like, for example, in June, it was very, very clear that the quarterly results are not going to be as bad as what the market was predicting. So doing lump sum investments of mutual funds more than what your asset allocation permitted, maybe 10%, was also a good tactical opportunity in June. And the March opportunity and the April opportunity was structure product.
Okay, so Feroze, if the expectation is that the market is going to go down or the market is going to remain flat, would this change?
See, I think having an expectation itself is wrong to my mind. Most experts actually have an opinion on the market every single day, which I strongly disagree. There will be only very few days in a year, 1 or 2 days in a year maybe, if God is generous, that you will have a more clearer idea. I can't even fathom or believe that everybody has an opinion on every given day. When all things fall in place, that's not going to be every day. There's going to be 1 or 2 days in a year we would know. So most people have an expectation because there's a pressure to have expectations. Don't have an expectation every day because you can't actually count on your expectation, point one. Point two, to my mind, it's a differential equation which has so many variables which is not easy to solve. That's why you take more discipline as more of your backbone of your strategy than intellect in certain cases. So today we would rather allocate money with protection, which is what our structure products do. They protect 20%. To answer your question, Sumera, if you put your strategy in mutual funds, you may want to step in with 3-4 months staggered investment. If you're asking from a perspective of a new investor, structure products can go right in because they have a protection. So be a little more protected, be a little more cautious. Of course, there are variables which are unknown, what kind of impact it will have. But anybody calling the market and saying it will go down, don't believe them because they don't know. Only law of probability can make them right or wrong.
Yeah, how well said. Feroze, as always, a pleasure talking to you. Mr. Girish, thanks very much for joining in. And, it was a pleasure hearing about your investing journey as well from the last 25 years. Thanks very much to both of you.
Thank you. It was a pleasure talking to both of you.
And with that, it's time now for some interesting mutual fund analysis. Here's Bharat Rathore, Executive Director at Anand Rathi Private Wealth Management and also the head of their Bangalore unit.
Hi, Sumera. Thank you for having me on the show today. Today, we're going to be analyzing Axis Blue Chip Mutual Funds. As per our Anand Rathi selection methodology, we are giving Axis Blue Chip Fund a 5 out of 5 rating, which is a star performer. Axis Blue Chip Fund is an open-ended, diversified large cap fund. As per SEBI categorization, any fund which has 80% or more into large cap stocks is known as a large cap fund. The Axis Blue Chip Fund was launched by Axis Fund House back in the year 2010. And as of July end, the assets under management in this fund is about 15,945 crores. The fund manager is Shreyas Diwarkar. Shreyas comes with over 17 years of experience in this industry and has been managing the fund since November of 2016. Shreyas' style of investment is that of a growth strategy, which primarily means Shreyas is looking at identifying blue chip stocks, which can outperform the market in the long run, given the kind of future business potential that stocks have. The portfolio is a concentrated portfolio of about 25 stocks across 10 to 11 sectors, vis-a-vis the category average of about 44 stocks. The portfolio currently has 91% allocation to equity, of which almost 100% is quality blue chip stocks, and 9% is in cash and debt equivalents. At Anand Rathi, we evaluate funds using certain set of parameters like return, risk, return consistency, fund manager's capability to pick stocks, valuation, and future return potential. When we look at the fund from its performance standpoint, we measure it using the 3-year rolling return. The 3-year rolling return of the fund is about 8%, while the category average is about 0.88, which primarily means it's got the highest return in its category. And Nifty's return for the same period has been about 1%, 1.8%. The second parameter is risk. We measure risk using standard deviation, 3-year standard deviation. The 3-year standard deviation of the fund is very, very low. It's at about 16%, while the category average is 19%. And the standard deviation of Nifty for the same period is at about 21%. Looking at it from a valuation standpoint, the fund scores low, which can be seen through higher price to earning and price to earning growth ratios, which primarily means that Shreyas is willing to pay a higher amount of money for quality stocks which can deliver higher returns in the future. If you were an investor who invested into this fund a year ago, 1 lakh rupees, your 1 lakh would be about 1,07,000. And if you had invested the same 1 lakh into the Nifty a year ago, it would be 1,04,000. If you're an investor who invested into this fund at inception, which is in 2010, the value of your 1 lakh would be about 3,11,000 rupees. And at the same time, if you'd invested into the Nifty, 1 lakh rupees, the value of that would be 2,17,000. Clearly, you can see from the above parameters that why we call it a star performer. And therefore, we give a strong buy recommendation for this fund. Thank you.
Bharat, thanks very much for that very interesting take. With that, we'll wind down on the Investing Edge. Thanks very much for watching. The news continues on CNBC TV 18.